Hi there, welcome back to this my 7th data update for 2026. In this session, I'd like to talk about debt. And let's face it, debt might be a financial decision, but it carries other connotations. In almost every religion in the world, you're advised not to borrow money. And God help you if you lend money because you're viewed as an even bigger sinner. So sometimes we have to overcome those religious connotations before we look at debt. But in this session, not only am I going to talk about debt, I'm going to twin it with taxes. Because as I will argue, without taxes, much of the argument for borrowing money goes away. So let's get the session started. In the fifth data update that I did, I looked at hurdle rates, cost of equity and cost of capital. In my sixth one, I looked at returns, profitability and return measures. Debt was a player in both of those, but it was behind the scenes. The cost of capital for a company is affected, both the cost of equity and cost of capital are actually affected by debt ratios, as are net margins and returns on equity. But in this session, I want to focus first on the trade-off that every business, small or large, private or public, no matter where you are in the world, trade-off that businesses face when they decide whether to borrow money or use their own debt or equity, and look at how companies behaved in 2025 when it came to making that choice. Along the way, AI will enter the picture. Why? Because in 2025, AI entered every conceivable picture. You saw it in my previous data updates. And here I want to talk about the incredible capital expenditures going into AI and how debt is becoming a player in financing those capital expenditures. So lots on our plate. Let's get started. Before we embark on talking about the trade-off between debt and equity, let's lay out the difference between debt and equity. At first sight, you're saying, hey, why would we care? It's already on the balance sheet. If accountants are completely consistent about classifying debt and equity, you could say, well, I don't have to know what debt and equity is. Accountants have done it for me. But I'm going to argue that accountants are not always consistent. And one way to detect inconsistencies is to go back to basics and look at what it is that sets debt apart from equity. Let's start with the two characteristics where debt is always different from equity. The first is debt gives you a contractual claim on the cash flows. In a traditional bond, this takes the form of claims for coupon payments and the principal. But even if it's a floating rate debt, the floating rate is set based on a contractual structure. The rate is set 2% above the treasury rate, the prime rate, whatever the trigger rate is. And second characteristic of debt is that you get first claim on the cash flows, both in operations and if you go into liquidation. In contrast, equity gives you whatever's left over in cash flows. There's no contractual claim. It's a residual cash flow. And it's a last claim. You're always last in line for the cash flows, which is one reason for most companies, the cost of equity will be higher than the cost of debt because you're always last in line. There are three other characteristics which are true most of the time. First is debt gives you a tax advantage. In much of the world, interest expenses are tax deductible, cash flows to equity are not. You're saying, why isn't this always? Because there are some parts of the world, the Middle East, for instance, where interest doesn't give you a tax savings. And there are other parts of the world, and I can think of Britain, UK, and Australia, where there are components of the tax code that try to give you a tax benefit with equity. In Brazil, it takes a form of interest on capital, a tax deduction you can claim on book equity. And the UK and Australia, it takes a form of investors getting a tax credit for taxes paid by the government. The second is, in most cases, equity investors run the business. They have an active role in management. So if it's a publicly traded company, they do it through the board of directors that in theory at least they elect, and the board picks a management for them. If it's a privately owned business, the owner runs the business. Lenders, for the most part, are not actively involved in management. And here again, it's not always, because sometimes lenders get a role in management, especially if there are covenants in debt where they get a seat on the board of directors and veto power over major decisions. The third distinction, and this is again mostly true, is debt has a finite maturity. A 10-year loan, a 20-year loan, same with bonds. And equity usually has no maturity specified. At least in theory, your equity can keep going and going for as long as the business is around. Now, the reason I said mostly is some of you might have read about the Google 100-year bond that was issued just a few weeks ago. 100 years is well beyond your lifetime and mine. And the British and the Canadian governments used to have console bonds, which lasted essentially forever. But most of the time, debt has a finite maturity, equity doesn't. What I would suggest you do is go through a balance sheet to see whether the debt that is classified by accountants as debt meet the characteristics and whether there are debt items that don't show up. Until 2019, one of the things I had to do for every firm was convert lease commitments to debt because accountants were not doing it. And the reason I did it, if you look at the characteristics of debt, leases have always been debt. With that distinction in place, let's talk about the trade-offs. I'm going to start with what I call the false or the fake trade-offs, reason given by so many companies for borrowing money that really don't hold up, or not borrowing money. Let's start with one reason. Debt is cheaper than equity. On the face of it, that's true. Debt is cheaper than equity, but you saw why, right? Lenders are first in line, equity investors are last in line. So you're saying, why shouldn't I take advantage of the cheaper debt? Because it's an illusion. When you borrow money at the cheaper debt, your equity becomes riskier. In the absence of tax benefits, your cost of capital will either stay the same or only go up. There are no benefits to replacing more expensive equity with cheaper debt because the risk just gets passed on somewhere else. Intuitively, the risk of your operation, which is what you're funding, cannot change just because you change the funding or the financing mix for the business. The second argument, and this used to be the favorite for real estate developers, is borrowing money will increase your return on equity. Again, technically true most of the time. By borrowing money, you have less equity at play and a higher return on equity as long as the return you make on the project exceeds the cost of debt, which is kind of a minimal requirement. That said though, that higher return equity comes with a higher cost of equity. Equity is riskier. In other words, if you take a neutral project, levering it up will leave it a neutral project. It is true that if you're a good stock picker or a good project taker, borrowing money will allow you to leverage up your winnings, but comes with the cost of higher risk. On the other side of the divide, there are people who will never borrow money because of lower net income. Again, technically that's true. You have interest expense, lower net income. But remember, you have less equity at play. So you could conceivably and often do have a higher return on equity or a higher earnings per share if you're thinking in terms of per share numbers. The other argument against that is it'll make us riskier, lower our ratings. Again, absolutely true. Your default risk goes up when you borrow money, your ratings will be lower. But remember, the end game in business is not to have the highest rating you can, but the highest value you can. Put simply, a company with a AA rating that borrows money could be worth a lot more than a company with a AAA rating that never borrows money. So those are the illusory benefits or the fake benefits. Let's move on to the real trade-off. The biggest benefit of debt is a tax benefit. Interest expenses are tax deductible, and the higher tax rate, the greater the tax benefit. So countries with higher marginal tax rates should see more companies borrowing money than companies with lower marginal tax rates. The caveats, of course, are you need to make money. The tax benefit is not a check mailed to you by the tax guys. It's basically you got to make money to claim the tax deduction. Second, if you're a company that basically has no income right now, you can carry those tax benefits forward. And you got to factor in the reality that those tax benefits can change over time as the tax rate changes. But that's the biggest benefit. In terms of a secondary benefit from borrowing money, at least at big publicly traded companies where managers don't own much equity, that can make you more disciplined. It's kind of an extreme way to impose discipline, but by forcing managers to borrow money, you make them face the consequences of taking bad investments. You're saying take bad enough investments, you might not be able to make your interest payments, and you might lose your jobs. That makes it real for them. As I said, it's an extreme way of disciplining management. Those are the pluses. There are two minuses. The biggest minus is when you borrow money, you increase your risk of default. Even if you're the largest, safest company in the world, it increases your likelihood of default by perhaps from 0.01% to 0.03%. And for other companies, be a lot more. The probability of default goes up. You're saying, so what? Well, you can default and that truncates your business. You'll never get those growth assets. But even if you don't actually go bankrupt, the perception that you're in trouble and might go bankrupt affects your operations. How? Customers stop buying your products. Suppliers demand cash. Employees start leaving. There's a secondary cost that comes from borrowing money. Equity investors have one set of incentives. Lenders have a very different set of incentives. Equity investors want upside, lenders worry about downside. As a consequence, when you borrow money, those interests conflict. And when they conflict, they take the form of covenants, legal agreements, higher interest rates. There is a cost to be borne, and that has to be factored in. So those are the real trade-offs. But there's finally a set of frictional trade-offs. This comes from frictions in the marketplace or how managers think. One is the biggest problem, the biggest cost of borrowing money is bankruptcy. Anything that governments do that provides protection against bankruptcy will induce companies to borrow more. Like what? In Korea in the 1990s, the Korean government acted as an implicit backup guarantor for Korean companies borrowing money. So basically it told banks, look, if they have trouble, we'll step in. And guess what Korean companies did? They borrowed up to the hilt and beyond. In the case of too large to fail, where a government steps in and bails out a company, what's the message they're sending? If you're a big company and you borrow too much, we'll protect you. So bankruptcy protections can induce companies to borrow more than they should. Subsidized debt. What is subsidized debt? Debt at a rate lower than you should be paying given your default risk will induce you to borrow too much money. Why would you get subsidized debt? Well, because you're viewed as serving a social purpose, green energy companies, or because you serve a government or a government interest or a defense interest, defense companies and infrastructure companies. Subsidized debt will cause you to borrow more than you should. And third, and this is a big factor in family and founder-run businesses, even though you always have the choice between using debt and equity, when you use equity, you have to give up part ownership of your business, which means you're also risking loss of control. For many founders and families, control is such a critical component that they will choose to borrow money even though it doesn't make sense. Much of the Middle East, there are no tax advantages to debt. In a purely financial perspective, Middle Eastern companies shouldn't borrow money, but many of them do because they're run by founders and families that value control. On the other side, here's how the frictions might keep debt too low. The first is, if you have covenants that are so restrictive that you can't run your business well, you might say, I don't want to deal with that. I won't borrow money. In fact, you could argue that technology companies over the last few decades have been reluctant to borrow money precisely for that reason. They don't want lenders and ratings agencies looking over their shoulder, tracking their R&D and where they invest money. The second is, if your shares are overpriced, the market's made a mistake in giving you too high a price, you might be tempted to use that equity because you're using overpriced currencies, especially in acquisitions and in big investments. And thirdly, there might be regulatory constraints that essentially keep you from borrowing money. Those regulatory constraints can take the form of limits on book value debt ratios or how much interest you can have relative to EBITDA. But these frictions can play out. The bottom line is there are lots of forces playing out in debt and equity. And if you find this too fuzzy and you say, look, I'd like something more precise, there's a way to do it. And the way to do it is to go back to hurdle rates and latch on to the cost of capital, which is a weighted average of your cost of equity and your cost of debt. Since your objective is to get the highest firm value, if you can keep your operating income stable through debt changes, your objective becomes minimizing your cost of capital. Put simply, your optimal debt ratio becomes the one that minimizes your cost of capital. You're saying, this is easy. All I have to do is change the weights on debt and equity. Not so fast. Because as you borrow more money, both your cost of equity and your cost of debt will go up. Your cost of equity will go up because your equity earnings become more volatile. Your cost of debt will go up because lenders worry more about default risk. So it's a dynamic process. It's not complicated. You can compute the optimal debt ratio for a company, but don't be surprised to see it very different from the actual debt ratio for a company, either because companies use fake reasons to borrow and not borrow money, or the frictions are playing out. So with that lead in, let's talk about what the world looked like in 2025 by looking at the two big trade-off items, taxes and default risk. When you start thinking about taxes, you have to confront the question of what tax rate am I going to focus on? You're saying, what do you mean, what tax rate? There are three variations of the tax rate. There's a marginal tax rate, which is the tax rate you pay on your last dollar of income, where you're likely to find it not in the financial statements, but in the tax code. There's the effective tax rate, which you compute by going to the income statement, taking the taxes paid and divide by taxable income. It's an accrual number. It really doesn't mean that you paid that much in taxes, but that's the accounting taxes paid. And there's a cash tax rate where you take cash taxes paid with the information is in the statement of cash flows and divide by income to get a cash tax rate. Marginal tax rates, effective tax rate, cash tax rates. What do they look like in 2025? Let's start with marginal tax rate in 2025. I would say I computed marginal tax rates, but I took them from the tax foundation, but the accounting firms also tracked them. I've divided the world based on the level of the marginal tax rate. The red parts of the world have the highest marginal tax rates, higher than 30%. But before you get too excited, if you'd seen this graph 40 years ago, the differences would have been much greater. The tax rates around the world have been converging around 25%. So even the parts of the world, the red parts which have higher tax rates, the tax rate is not 50 or 80%. It's 30, 33, 34%. The green parts of the world, Eastern Europe, parts of the Middle East, Russia, have the lowest tax rates. The yellow parts of the world are the center of the global economic universe. And as you can see they've all kind of centered around the 25% tax rate. The US right now is at 25.63% tax rate. 10 years ago, the US was in the red section, one of the highest marginal corporate tax rates in the world, until it realized that what mattered was not tax rate you claimed to be charging companies, but what tax rate you collected. And here's where effective tax rates come into play. In this table, I've looked at using aggregated values for taxes paid and taxable income for all tax-paying companies, the marginal and the effective tax rate. Let's go around the world. As you look at marginal and effective tax rate, if you focus on the US, the marginal tax rate is about 25%, or 25.6%, according to some sources. The effective tax rate is 19.38%. Saying, what does that difference tell you? Well, roughly speaking, you can think of it as a measure of tax code efficiency. If you have an efficient tax code, your effective and your marginal tax should be much closer. If you look at EU and the environments, marginal tax rate 23.25%, and the effective tax rate is actually higher, but it's a little tricky there because you're parts of the EU like Germany with a marginal tax rate of 29%, and parts of the EU and Eastern Europe where the marginal tax rate is 15%. And to the extent of a lot of foreign income, that can tilt the numbers. But as you look around the world, India with the difference between the effective and the marginal tax rate has the least effective tax code, with the caveat again that this might just be capturing foreign income being taxed at a lower rate. I also computed cash tax rates for companies, and those rates are about 1% higher than the effective tax rate. So the story that companies pay a lot less in cash taxes is not true, at least in the aggregate. So marginal tax rates, effective tax rate, cash tax rates. You're saying, why look at all three? When it comes to the cost of debt and the tax savings, the marginal tax rate that matters. Why? Because interest saves you taxes on your last dollars of income. So marginal tax rates matter, but it's still good to know that there's a difference between marginal and effective tax rates. Now that we've talked about tax rates, let's talk about default and distress, at least as it played out in 2025. Let's start with the good news. The good news was, default rates in 2025 remained low. Now, in fact, they were at 1.47% in 2025. So if I just focused in on that, it was a good year from the perspective of lenders. There wasn't much default. That said, though, there was a lot of stuff happening under the surface. During the course of the year, in May of 2025, Moody's estimated probability of default at U.S. companies. So think of this as a forward-looking number at 9.2%, a post-2008 high. And there were more ratings downgrades and upgrades during 2025, and about $60 billion in corporate debt slipped below investment grade, below BBB. So clearly people were worried even though defaults were not showing up. Now, if you talk about bond ratings in this table, I've looked at rated companies around the world. Let's start with some non-surprising numbers. First, more companies are rated in the US than any other part of the world. You're not surprised by that. But even in the US, which is the highest percentage of rated companies at 11.43%, 88.6% of companies don't have a rating. And around the world, you can see that 97.6% of companies don't have a bond rating. Now, among rated companies, I've also broken companies down to investment grade and non-investment grade. And this might surprise you. The US has the highest percentage of companies with below investment grade ratings. Now, it doesn't surprise me because in the rest of the world, companies often will choose not to get rated unless they think they can get a high rating. The US, because you've had a longer history of ratings, companies that were rated 10, 20, 30 years ago have slid in the ratings. So it kind of gives you a picture of what the world looked like in 2025. It wasn't a huge change in 2025, but it'd be worth tracking this table in 2026. Now, with that lead-in of taxes and default, let's focus in on how we can measure how much companies borrow. There are lots of different metrics. The first two I call debt comfort metrics. In other words, how comfortable are you with the debt you've taken on? And I capture that with two ratios. One is an interest coverage ratio, earnings before interest and taxes divided by interest expense. You want that number to be high as a borrower and a lender because it means you have a lot more buffer to make your interest expenses. But debt doesn't require just interest expense. It also requires principal being repaid, and that you can capture the comfort by looking at how much debt you have relative to EBITDA. EBITDA is a rough measure of cash flow, and in this ratio, you want a low number if you want to be safe, because then you can pay off your debt much more quickly. So that measures debt comfort. To measure debt burden, I look at how much debt you have relative to total capital. And here, again, I have two choices. I can measure that relative to book value, accounting equity and accounting debt, or market value, where I look at it relative to market value. You're supposed to use market value of debt and market value of equity, but people often cheat because book debt and market debt are pretty close for most companies, and look at book debt as a percentage of book debt plus market value of equity. Now, again, with debt itself, I have two choices. One is to look at the total debt I have, which includes leases, and the other is to net cash out and come up with net debt. So let's start with the debt comfort metrics by sector in 2025. So what I've done here is for global and US companies, broken companies down by sector and computed again the aggregate values. Think again of this as the weighted average and the distribution of the ratios across companies. So you look at the aggregated values and you look across sectors, it's quite clear that technology has the most buffer, both when it comes to interest coverage ratios and debt to EBITDA. It has, it's most protected. And real estate and utilities have the least buffer. Don't read too much into this for the moment, but clearly, and that's not unexpected. That's true for both the global and US. Notice also that the aggregated values give you more buffer than the company-specific numbers. It goes back to what we saw in the earlier post. It's the bigger companies that have the most buffer. The smaller companies have much more to worry about when it comes to debt. Now, if you look at the debt level metrics on an aggregated basis, I've computed both gross and net. You get the confirmation of what we saw in the previous table. Technology has the least debt, and real estate and utilities have the most debt. Notice, though, the difference between book and market. On a market debt ratio, technology companies have only about 6.27% debt to capital, gross debt to capital on a market basis, but on a book basis, 32%. Now, the reason I've done the book debt ratios is there are still companies out there that hold on to book debt ratios. I think it's a mistake, at least in financial analysis, to look at book debt ratios, because they give you grossly skewed estimates for the cost of debt and the cost of capital, where you're raising money at today's market prices. I've also reported the net debt numbers on an aggregated basis. And here again, you can notice the difference between what you get in the aggregated values and the company-specific distributions reflects large versus small companies in each sector. So bottom line, if you look at debt levels, they vary across sectors. Now, incidentally, I do have the breakdown of both of these at an industry level for both global and US companies. And if you go to the end of this session or the notes to the session, you should see the links to both of those data sets. So now let's bring in the AI part of the story. As I said, in 2025, AI was part of every story. And one of the most astonishing ramp-ups in CapEx in a century has been happening in AI. Now, much of that, a big chunk of that CapEx has been coming from the big tech companies. And here I've taken 4 of the Mag 7, Meta, Amazon, Alphabet, and Microsoft, and it added 2 other players, Oracle and Broadcom, to the mix, and looked at the cumulative amount invested in CapEx and cash acquisitions. That's right out of their statement of cash flows. And as you can see, In 2025, these companies collectively invested about $400 billion just in that year in AI, in CapEx and cash acquisitions, a big chunk of it in AI. I mean, it's almost astonishing how quickly these companies are moving from capital-light businesses, which they were 6, 7, 8 years ago, to more capital-intensive businesses, huge CapEx. But that's only part of the story. It's only part of the story because there are other companies, smaller companies, that are also making big investments in AI CapEx. So this collective CapEx in AI is probably double what you're seeing in this graph if you bring those smaller companies into that mix. Now, as you look at this investment, say, why are they doing it? Of course, they're doing it because they see a huge market out there. Is that CapEx make sense? It's too early to make that judgment. Let me make a judgment based on what prior disruptions have brought for us. I call this the big market delusion, and here's how it plays out. You see a big market. You see entrepreneurs, founders, businesses look at that big market. And because these entrepreneurs, founders tend to be overconfident, people think they can conquer that big market. So what do? They invest way too much in that big market, thinking that they're going to be the winners in that big market because they're overconfident. Now, they get capital from venture capitalist investors who self-select. They like that founder and they think this guy is a great guy. They put the money in. So you got these pods of overconfident people investing too much and pricing their companies too much. You say, what does that all mean? If I add up the investment across all the companies, collectively they'd have overinvested. If I add up the pricing across all these companies, collectively they're overpriced. In fact, with AI, the promise is that AI is going to be a huge winner-take-all market. I've just pulled off this graph from, I think it's from one of the UN trackers of AI investment. And this estimates trillions of dollars in total market for AI. And you can see it play out in that investment you saw on the previous page, as well as the pricing you're seeing for these companies. Now, here's the problem though. Each of these companies thinks it's going to be the winner. It's investing and getting priced as if it is, but they can't all be winners. There's got to be a day of reckoning. And that day of reckoning always comes. And when it does, it might happen overnight. It might happen over years. There is going to be an adjustment. We call this, you might want to call this a bubble and it bursting, but this is a feature, not a bug, of big markets. Right now, the question is, what will that correction look like and what will the consequences be for the market? And to answer that, we have to bring in the financing side. Here again, focusing just on the big tech, the amount they've borrowed has gone up over the last few years. These companies used to be very light on debt, and in 2025, they borrowed almost $160 billion. Now, let me pause. That sounds like a lot of money, but these companies are cash machines. They can cover a big chunk of their investment and pay off this debt in a year if they wanted to. By itself, this debt doesn't bother me, except perhaps at Oracle and Broadcom it might be more of an issue, but collectively it's not an issue. The problem is when that debt is in the hands of smaller companies making much bigger CapEx investments. And here private credit enters the story. Private credit essentially is credit offered by private lenders outside of the traditional mechanisms. The traditional mechanisms for lending are banks and corporate bonds. Private credit has become a much bigger player in the last decade. Private credit has always been with us, but not in the magnitude that you see now. And two things are driving it. One is private credit thinks it has a place in the lending market that other lenders are not catering to. And we'll talk about that. The other is, and it's coming from the selling side, private credit is being sold as an alternative investment class, and there's a lot of money to be made. Now, the marriage of private credit and AI comes about because a chunk of AI is being funded with private credit. It takes a form of direct loans to AI firms, and those loans are much bigger. And as a percentage of overall private credit, it's not big yet, but it's climbing. You're saying, so what? The worry here is if there is a big market delusion and you go along with my story and there's a correction, if all of the money came from equity, the correction will be felt by the people invested, the shareholders of these investors in the big market delusion. The problem when you borrow money is you spread that cost out, because now it's not just equity investors, it's lenders as well. And the question with private credit is, what happens then? Now, if you're wondering what the sales pitch for private credit and AI has been, why they think that they're filling a space. The first is they claim they can assess, at least some of them claim they can assess default risk better than traditional lenders. Why? Because they can use more data that lenders might not use, qualitative data as opposed to the ratios that lenders use, that they can have access to, information on projects that lenders don't have. So that's a first. I'm skeptical, especially when it comes to projects that are bigger. The second argument that they make is that that they are in a better position to lend money to companies quickly and flexibly. And that's actually a reasonable point. It's true, banks have to go through processes, as do corporate bond markets. So if you want to borrow money quickly and you got to make the debt very flexible, lenders can do it. But you got to worry about that, right? Because if you speed up loans and you give these terms to borrowers that the prudent lenders would not, there's a danger of it blowing up. So the risk here is that there's a correction. The correction is no longer isolated to equity investors. It's going to bring lenders down. And you're already seeing some pain in the private credit market. In my view, private credit is a necessary part of lending, but it's become too big. It's become too big because it's been oversold. And I think that some of the lenders in this market, and I'm not going to make a blanket judgment, have been sloppy about how they lent money. A shakeout is coming, and that shakeout is going to make private credit smaller and perhaps healthier. But it's going to be painful. I know that sounds downbeat, but I think it's part of what markets do. They overreach and they correct. And with AI and private credit, it's a marriage made in heaven and in hell. There are some good sides and bad sides to it, and we might be seeing some potential bad outcomes. I hope you found the session useful, and I thank you very much for listening.